turn it over to Danielle DeMarco. She's our, as I said, our real estate investment focused mortgage broker, and she's got a presentation for you right now. Go ahead,
All right.
Danielle.
Thank you for the introduction. So, every couple weeks, I do a quick market update and share some information with you guys about on the financing side of things. So, last time I was here, I brought up the refinance program that was recently announced. We didn't really have any information on it yet, so we do now have some information. So, I just kind of wanted to touch on that. And then, because we have a lot of new attendees, just kind of chat about what investment financing is versus just kind of regular quote unquote mortgage financing. So to start off, the new refinancing program was launched by the insurers, which allows homeowners to refinance their home to 90% of their home value instead of just 80%. So this will eventually be a game changer for homeowners. It allows you to invest in real estate properties. So essentially, if you refinance to 90% of your home value, you can use that equity to build a legal suite, up to 4 units, actually. So, depending on your lot, like Tim and Azad were talking about, the types of lots that they're getting their clients to purchase for future investing, this could be a program that would be able to be accessed to put, laneway homes, suites above the garage, and legal basement suite, things like that, up to 4 units. Now, having said that, it's a great program that the government and the insurers have approved. However, as of now, there are currently no lenders that are on board with the program. So this refinance program is a little bit different. A standard refinance, you would refinance to 80% of your home value. You kind of get a check at the end of the day. You put the money in your bank account. You can use that for a down payment or whatever you want. But in this case, this type of program, because it has to be used to develop legal suites, the lenders need some form of tracking to make sure that you're actually using the funds for that. So they're actually treating it as a progress advance. So what that means is we would refinance to 90%. Let's say you're going to net 150,000. You would start construction on the legal suites, and every so often, usually 4 or 5 draws, they would advance funds to you after an inspection is done by an appraiser to confirm that the work is done and is being done properly. Permits would need to be pulled, etc. So this program is great for people that want to add multiple suites up to 4, where the funds requirement might be 60, 80, 100, $150,000 instead of just your regular purchase plus improvements. But again, because of the progress draws, as you can imagine, to manage all of the draws, create the internal system that allows for them to train staff on how to do it. Lenders are a little bit hesitant to jump into this program just due to the hundreds of thousands it's going to cost them to implement the programs. So while it is a great program, we likely won't have access to it until maybe fall or maybe even 2026 because the lenders need time to absorb it, think about it, come out with a program on the back end to account and basically allow home buyers to utilize the program. So it means we have to hang tight a little bit longer, but I did promise you all some more information on this seminar, so I wanted to update you on what it looks like. It will be progress draws through the insurer up to 90% to build up to 4 units on that specific property that you are refinancing. Once lenders are on board, I'll give you guys another update when we can start to access that. So one thing I wanted to kind of flip a switch on here is, again, like I mentioned, because we have a lot of newer people here today, is to touch base on how we essentially tackle investment financing versus just walking into your bank or talking to a mortgage broker about one specific property. So a lot of what we do here at Crew is help people accumulate multiple properties. In order to do that, you obviously need to use your income. You need to maybe use some equity. You need to have down payment. We need to be able to qualify for these properties. So traditional financing would be, hey, I want to buy a house. I need a mortgage. Investment financing is, hey, I would like to purchase maybe 3 or 4 properties over a term of maybe 3 to 5 years. I'm going to need to access some of the equity in my home for down payment. I have some in savings as well. And then your mortgage broker will formulate a plan. How can we purchase 3 to 5 properties? How much equity do we need to pull out of your current home? do we need to look at your mortgage on any properties that you currently own and redo those and structure them a little bit differently so that we can help you access that equity or so that we can help you qualify for additional purchases? So if you think about it, long-term mindset is pay your mortgage down as fast as possible. But when you start to think like an investor, you want to leverage the bank's money, use that to accumulate properties. So the way to do that, you kind of have to think a little bit differently. We need to extend out amortizations to keep payments lower so we're cash flowing. We need to extend out amortizations on properties we already own so that you can qualify. In mortgage financing, obviously, if you have properties and you have mortgages, that counts as debt in your application. The lower the payments are on those properties, the more advantageous it will be to help you qualify to purchase the next one. We also need to look at lenders. Which lender are we going to apply to for this specific property and why? Doing it in the right order is extremely critical to having a successful investment plan. If you go out of order on lenders or property types or property prices or occupancy, that can really derail the entire process and your entire plan. So it is really critical that you're not thinking about just one property and one mortgage, but instead we're looking at the overall plan, formulating a way on how we can reach those goals, and then we're purchasing the real estate to fit into that plan. So it's kind of a neat way of looking at it is putting on the investor cap instead of just the homeowner cap. And we get a lot into that. Tim and Azad get into that a lot. And on the investment side, on the financing side, we really do stress this and talk a lot about how to structure your mortgages because it really can make or break your ability to accumulate properties. So if you do have any questions about what that looks like or how financing needs to be structured, feel free to reach out. We've been doing it a long time. We have a lot of good suggestions on how to do that to make sure that we're able to reach your investment goals.
Sure.
Yeah.
Hey, Danielle, I don't know if you're looking at the chat, but there is a question for you in there.
Okay, the cash down. Okay, yeah. So Smith maneuver for sure.
Well, just wait before we'll repeat the question. Can you
Oh,
repeat
yeah.
it for everybody?
Yeah, no worries. Do you use cash damming and the Smith maneuver kind of financial strategies that convert mortgages into tax deductible mortgages? So I think you guys are getting into taxes a little bit later. So I'll leave that part of it to the
Yeah, he
professional.
does talk about it.
Yeah, but as far as financing goes, yes, absolutely. So what we want to do is break your mortgages into different components if you want to use the Smith maneuver. So we look at typically two, three, four components. It depends on your specific situation. We'll break it into different mortgage components with different mortgage balances. Then we will look at adding on a home equity line of credit component. With the Smith maneuver, the key is the home equity line of credit component needs to be readvanceable. And then, for example, we just did, I don't know if my client is on here or not, but we just did components where, maybe you're using a certain amount to develop a legal suite. We want to put that in a separate mortgage component. Then we are getting the mortgage on the property. So that's going to go in a separate mortgage component. Then we may want to get a down payment for another property. So that's going to go in a separate component. And then we want access to a home equity line of credit for something down the road. So putting it into all of these different components is really critical so that your accountant can keep track of what interest and what mortgage is being used for what purpose so that we can, basically do that Smith maneuver. So yes, it's something we do and something we talk about. And I will let other people get into the tax side of things. I handle setting up the financing side of things to make sure that it meets those requirements.
Okay, thanks a lot, Danielle.
Hey, you're welcome.
Once again, great information for everybody. We're going to